Yeah, yeah, go right ahead.
All right, folks, we'll go ahead and get started straight away. So my name is Paul. I'm the librarian here at Thomas Crane Public Library. I'm here to welcome you and thank you all for coming out to our program tonight, which I think is going to be super, super interesting. But I don't want to miss a chance to cross-promote. So we do want to remind you that on Sunday, January 23rd at 3 p.m., we have concert pianist Roman Rudinsky performing in the historic Richardson building. So please come on by for that. That's the first in our winter and spring concert series that we're going to do one. But enough about that. We're very happy to have here tonight Jeff Sullivan, who is a registered investment advisor and president of Peacefield Financial, and is here to demystify investing for all of us beginners. So please join me in welcoming Jeff.
Hey, thank you, Paul. Appreciate it. First off, I want to start by saying thank you to Paul and the rest of the team here at the Quincy Thomas Crane. As a kid growing up in Quincy, I was always here. I mean, I loved it, and it's such a beautiful building. And to be invited to speak was it's a nice little honor, you know, especially for a kid from Quincy. So, Peacefield Financial, I'm going to talk about a few things. I forgot where my clicker was, so I grabbed my mouse, and I think it's going to work. Then again, maybe not. Paul, we're having technical difficulties already. Let me, oh, come on in. So here's a really good looking picture of me. It's old. This is pre-COVID 30, 40 pounds probably. I actually could fit into my suits back then. Tonight's going to be fun. I know that normally doesn't go with financial planning and financial literacy, but we're going to have a little fun. It's going to be interactive. As a guy that grew up in Quincy, you'll learn a little bit about my experience, but you'll find that since we all pretty much are from Quincy in the South Shore, right, we like to have fun. And serious matters can be spoken at serious times, but tonight, this is a serious matter, but let's enjoy ourselves, right? So there I am, yeah, pre-COVID. Let me go through. This was working perfectly, by the way, before.
Less gray hair, too.
Yeah. Thank you. Thank you for noticing that. I had a 4-year-old. I have a 4-year-old.
At least you have it.
Yeah, exactly. You know, I was going to say I have a 4-year-old. I had him 7 years ago, but then I would have lost all credibility because I'm supposed to know math as a financial guy. Like, he said he has a 4-year-old, but he had him 7 years ago. Wow, not very good. But yeah. It was a little little time ago. I think it was 5 years ago. Maybe some Grecian formula. Maybe. Not going to admit it nor decline it. But we're going to talk about a few things, right? Why financial literacy is important. Obviously, get more from life. We can't do much without it. But before we dive into that, I want to talk a little bit about, again, who I am and why you probably want to listen to me. Again, it's Jeff Sullivan, born and raised in Quincy, educated through the Quincy Public Schools that afforded me a nice little trip out to Iowa, where I went to college. Post-college, I lived in Los Angeles. And then I lived in New York City for a long time through the decades of the 2000s. And the investment house that I worked in at that time moved up to Boston. So I said, well, hey, why not? You know, I'm the youngest of 4 kids. I set the record at Quincy Hospital back in 1971, 11 pounds, 4 ounces. Now, it's no longer there. And as the administrator of Quincy is everything, I already know that people are very upset that we don't have a hospital. However, I'd like to think that I'm going to hold on to that record of being the largest, fattest kid. I mean, let's be straight. 11 pounds, 4 ounces. God bless my mother. And if she's watching, how you doing? All right. So anyway, that's who I am. My investment career started again in 1994. Can't believe it's 28 years that I've been doing this. I've worn a few hats. My years in New York City, I was a trader, as well as an investment wholesaler working on Wall Street. My job there was basically to educate and advise the advisors, the wealth managers. Yeah, grab one. If it's there, it's yours. And then after we moved back to Massachusetts, I took all that investment experience and I said, you know what? If I can do it in New York City, if I can make it there, I can make it anywhere. And I think I'm the first person to ever say that. I think. You're too young to remember that. What was that, Rhoda? That was something, whatever. But Mary Tyler Moore? Yeah.
That wasn't in New York.
Oh, that was in Chicago.
That was in
Minnesota.
Minnesota.
Well, I can tell you that. I'm not too worried about Minnesota. I'll make it in Minnesota. Yeah. Okay, well, it was great coming out. Thank you so much. I have a blast. So, a handful of years ago, I started Peacefield Financial. We're a retirement and wealth solutions outfit. For compliance sake, I need to let you know, my broker-dealer is Cetera Financial. What does that mean? Cetera Financial is my broker-dealer. Essentially, in layman's terms, I pay them money to make sure I'm a good guy. Right? That's it. They're my compliance arm. They allow me to trade my clients' money, asset allocate, etc., things that we're going to talk about tonight, as well as my clearing firm is Pershing. Right? So any money that my clients give me goes to Pershing, which is an arm of Bank of New York Mellon. You know, so being a Quincy guy and having Quincy clients, you get some good questions like, so where does the money go? Like, does it go to the Quincy Savings Bank? So, no, it doesn't go to Quincy Savings Bank. It goes to the largest bank in the world. So it gives people confidence in knowing that, right? So tonight we're going to talk about financial literacy. What is it? Well, it's a lot of things, right? And you're going to find that, let's see, let me jump through here. Financial literacy creates financial goals, and we all have goals in life. And believe it or not, a lot of us don't. We think we do, we just haven't compartmentalized those goals. So when you look across here, the spectrum of different financial goals, think about it. You have financial goals with a vacation, college, emergency cash, right? You should all have 6 months of emergency cash, no matter what, right? Weddings, new home, etc. These aren't new. However, it's rare that people write them down and say, this is what I need to do to compartmentalize my wealth. My strategy needs to start today. How do I do it? How do I plan for the wedding? It's simple. You take money and you carve it out and you put it there. The same thing for retirement, travel, etc. I think, has anybody gone on a vacation where instead of paying lump sum up front for it, you decided to go ahead and dollar cost average essentially? Every month you're paying a little bit to that vacation. Anyone? I did it once, right? It was a free trip. It was like I won a free trip. $600 every month, and then after a year, my girlfriend at the time and I went on this amazing cruise, and I was like, I didn't even pay for this. It was insane how good it was. But those are the little things that you can go ahead and create. And those things are obviously memories, okay? So from there, financial goals. Now, you look at the last slide and you say, geez, that's a lot of goals. You know, I don't know if I have the money to be able to do that and afford it. Well, the financial reality is not a lot of us do. So don't feel alone because you don't have those assets, right? Think of this. 4 in 10, 40% aren't able to cover a $400 expense. I was saying Ryan, he just turned 21. As he goes out to the bars and restaurants, 4 out of 10 people, that means 4 out of 10 people that are bellied up to a bar can't even afford to pay that tab without going into debt, right? So for younger people watching, don't be one of those people. Don't be picking up the bar tab either. Don't have to do that, right? Because I can tell you, partners like you having money and not debt. It's important. So don't pick up the debt. So 3 steps to financial freedom. Again, there's three constants. They're not even variables. The cash savings, your checking, money, etc. Your savings in checking account, your asset accumulation, and your wealth transfer. I'm going to touch on all 3, and then throughout, when we wrap it up, we'll go back, we'll ask questions in regards to what we didn't cover, and then we can talk a little bit more in regards to the questions that you have. But cash savings, this is your savings account, right? People love Well, at least I did when I was a kid, looking at my little passport and seeing my savings go up, right? Kind of cool thing about this is when you look at the U.S. personal savings rate, what jumps out? Obviously 2012 jumps out at you. Does anybody know why 2012 jumps out where the average savings was 12%? Which is huge. It's a huge number. Remember in 2009, 2008, 2009, 2010, 2011, we had the credit crunch, right? We had the troubled asset relief program where Geithner put together $700 billion to bail out the banks that took on the credit default swaps and so forth. I was in Dallas, Texas in 2009 at a conference that we just paid $50,000 for me to get up and present to 900 people. The night before the conference, I was sitting there talking to my counterpart at AIG, the largest insurance company in the world. And he says, I'm Sullivan, so of course I'm Sully. He says, Sully, you going on tomorrow morning at 9? I said, yeah, I'm kicking off the meeting. He's like, yeah, listen, we're probably going to declare bankruptcy. I'm like, I'm sorry, what? Like, I mean, there's rumblings and stuff. He's like, yeah, so, yeah, Hank Greenberg he's going to probably declare bankruptcy. So we're, I don't know, I'm going on after you, but I might not be here. And I was like, well, why wouldn't you be here? He said, because here's the thing. We're the largest insurer of airlines and aircraft in the world. And if we declare bankruptcy, you're going to walk back to New York City. So it's like, all right. So finished my drink, went up to bed, rehearsed my presentation, and I got up, and I quite possibly, next to this presentation, of course, right, did the best presentation of my life. I got up on stage. There was about 400 people, not 900, meaning 400 financial advisors. I'm like, you should all leave the business. You're terrible. You should not be in this room listening to me. You should be taking care of your clients' worries. But I get up there and I said, hi, my name is Jeff Sullivan. I work for blah, blah, blah. We spent really good money to go ahead and speak to you today, but I'm going to go ahead and give it back to you. In the next 45 minutes, I'd like you to go back to your room or wherever and use that time allotted to go ahead and call your clients and tell them with the investment vehicle that you're invested with us, you're insured. You're fine. You have nothing to worry about. However, if you're not, definitely go ahead and talk to them because it's going to get really ugly in about at 9:30. Right? So got out of there and I flew to the airport. I was seriously like, I'm going to walk back to New York. And I got home. But the reason why I tell you that story is it scared the bejesus out of everyone. People were afraid because you couldn't even invest in banks. Banks were going under, right? There were insurance companies that were buying mom and pop banks in the Midwest, Minnesota, for like $12 million, so they could go ahead and qualify for the troubled asset relief. It's insane. But we as Americans recognized a problem with the banking system, the repeal of the Glass-Steagall, et cetera, and we started saving more. But we are Americans, and our memory is short. So we started spending more, and that's great. We want to spend. Spending more facilitates the upward mobility in your portfolios, your stocks, bonds, et cetera. You spend, you're buying things that are in your portfolio, right? It helps. It's good. It's a cyclical process. But anyway, we go through there, and we learned a little, we forget a bunch. So start with a budget. So in your bag, I hand it out, and if you're at home, just grab a pen and paper. But we're going to talk about this, and you don't have to grab it now, but we're going to talk about this at the end of the presentation. It's defining what wealth means to you. It's a nice interactive way to go ahead and create conversation and create things that you want to do and you think about. But you know, on this thing, it says our trip to Paris was really wonderful. It's like, that's what wealth means to this person. What does it mean to you, right? And I think once we build the plan, there's no longer like, oh, well, paying my mortgage is just so wonderful. I love paying my car insurance. No, we want to have memories, not bills, right? So, here's just a quick question on paying off debt for your cash savings, right? So, who would pay off the debt or who would save? right? So with show of hands, who would pay off the debt? All right? Okay. Who would save instead of paying it off? All right. So one person would save. All right. So, and since nobody knows who raised their hand, that one person, I'm going to show you why you were wrong. They're over there. No, I'm kidding. But there's this old saying, it's better to be safe than sorry, right? We grew up with it. I'm going to take my money, I'm going to put it under my mattress, it's going to be safe, I'm not going to lose anything. Well, today the Fed came out. Anybody know what the inflation number was? 7%. Highest in 32 years, was it? 7%. The easiest math on that is if you were to buy a bag of chips today, it's $1, right? Last year it would have cost you 93 cents, pretty much, right? So the average cost of a movie ticket, clearly, again, not to harp on our friends in Minnesota, but $9? I mean, really? I haven't been to a movie in 20 years, but I know it was more than $9 back in 2022, which is, or excuse me, 2002, which is absolutely mind-blowing. 20 years ago was 2002. That's crazy. So anyway, this is what inflation is, and the reasons being is you don't want to keep a ton of money in your cash savings. Cash savings accounts don't do anything except get bankers rich. That's all they do. They take your money, they invest your money. That's all they do. There is a lot behind that, but you know, for simplicity's sake, that's pretty much all they do. So, cash savings are great. Again, keep 6 months in bills for your needs. If you have more, it's fine. Less, something to work about. Also cash savings, and then there's 1,000 slides, by the way, in regards to this. I try to go ahead and define brevity, so I want to reduce a lot of it. For the younger folks, like Ryan, we were talking earlier, life insurance gets such a bad rap. It's a terrible, terrible rap, and it's really unfortunate because life insurance is kind of a really good investment vehicle, and if you have the right financial advisor, they can really find some great tax loopholes. And I love the word loophole. It's legal. It begins with L, right? That can really facilitate some incredible tax-free income using life insurance vehicles. But in this case, for cash savings, these are two examples of why starting early matters. The biggest asset that you have is not in your wallet, it's not in your bank, it's not in your 401k, it's not your house. It's the time that you have between now and when you decide to start using it. So, at a male at the age of 30, this is on a 30-year contract, you're spending $62 or $2 a day to get a $500,000 life insurance policy, right? The total spend on this term life insurance is $22,000. So as Ryan said, he's like, that doesn't sound right. You're giving me $2 a day is going to give me $500,000 if I die? It's like, yeah. If you die, that $500,000 is going to go to someone, your beneficiary, and the coolest part is it goes tax-free. Pure tax-free, that's $500,000. So there's little things that you can carve out to do while you're still young, for those of us in this age bracket and so forth. And again, time savings, it's less expensive when you age. Now, to just wrap up this one little piece on life insurance, I think we all grew up again in that it sounds too good to be true, right? It's like, I spent $22,000. If I died, you gave my beneficiary, my mom, my dad, my wife, my husband, $500,000. The thing is, if he lives to 60, what happens to that $22,000? It's gone. The insurance money, the insurance company won. Right? So that's the caveat, if you will. That's why life insurance sometimes doesn't get a great rap. It's like, well, I bought a term policy. Just to know, in regards to life insurance, there's tons of different types of vehicles. You have universal life, variable, whole, term, etc. I do a lot with my financial, just on a side note, for my financial planning, I do a ton of life insurance simply because it makes sense. I can't do, there's no reason why, if I'm going to pick a ARKK ETF, Kathy Woods ETF, and double your money, granted if I invest in July I would have cut it in half, but there's no reason for me to make money if the IRS is just going to come in and take it, right? So it's always a good way to go ahead and facilitate some of the prudence of portfolio building. Anyway, so that's cash savings, right? Learned a little bit about why to use it or why not to go ahead and continue to use it. Asset accumulation, this is when you hear of these asset accumulation, stocks, bonds, etc., mutual funds, exchange traded funds, ladder bonds, everything like that. There's three constants that we look at. Again, time, the money that you have, and then the rate of return. From there, let's see, I just blew right through that. So, again, the value in the asset accumulation, the value of time. Time is our biggest asset. And this is just a basic hypothetical in regards to the number of years you have to invest if you were investing $100, $200, $300. Right? This stuff is, you've seen this before. If you do have questions on, obviously you can call me and we can get into it a little bit further. But again, it's just the more years you have, the better off you're going to be. Not to beleaguer this one, however, I run some large retirement plans, 457s, 401ks, 403bs, etc. Over the last handful of months, there's been incredible volatility in the NASDAQ composite, mostly. The S&P 500 has been cruising, the Dow Jones has been cruising, the major indices have been cruising. The tech market has been getting really beat up, with some positions down 20+% just year to date in the last 11 days. It's very aggressive, and you're just like, wow. So I get calls from folks, and they're like, hey, you know, I lost $11 the other day. It's like, life is gonna end, man. It's over. Yeah, 11 bucks. But kidding aside, I don't care if it's $11 or 11 million, that means something to these folks, right? So when I get a call and it says I lost some money, I have to go ahead and talk to them, clearly. That's what you do as a financial advisor. Outside of, you build portfolios. The majority, I would say 80% of my time, is spent talking to my clients. Just, it's gonna be okay. We're gonna be fine. We have a very solid structure here. There's a process. We walked you through it. We educated you. The thing about this is, for anybody participating in an employer retirement plan, on average is 253 days a year that the stock market's open. 253 days, right? So when you start to think about it, it's like, okay, I participate in that, or I have an IRA or something, right? Every 10 years, that's 2,530 days that you're going to participate in the stock market or the bond market or the emerging markets or international, et cetera. That day that it's down, 100 points or 500 points or 1,000 points or even, that's one day of potentially thousands. So when you really take a step back and you look at it, and it's going to be okay, right? When we first started talking, or when I first started talking, I talked about how if you just continue to sustain life, spending money, right? Don't save, just spend it. You're still supporting the underlying assets that are held in those investment portfolios. So that cyclical nature, by you spending money, it's going really right back to you in the form of the fundamental principle of being earnings. So, again, a little bit more about weighting asset accumulation investments to save. When it comes down to year 1 to year 18, for the finer print, it's if you were saving a total of $25,000 a year at an 8% hypothetical return, you'd reach $100,000 in 18 years. It's, again, time, it creates most opportunity. Okay, so with the accumulation of assets, you have these three different buckets: taxable, tax-free, tax-deferred. All right. Taxable is referred to as non-qualified. In any type of sit down with your advisor, he's going to talk about, or she's going to talk about non-qualified assets versus qualified assets. Qualified is tax-free and tax-deferred. Non-qualified is stuff that you're paying taxes on, right? If you are invested in, you decided to take, say, $1,000 out of your savings account and invest it into a stock, and that stock happened to go up double, let's just say hypothetically in a year, that 12 months in one day, that's a long-term capital gain. You'll be taxed at 20%. So if you made $1,000, you got to pay Uncle Sam. 200 of that, you net $800. It's a nice thing. If you were to sell day 364, that's a short-term capital gain, and that's going to be taxed as ordinary income. Not good. It's terrible. You don't want to pay ordinary income tax because it's usually going to be higher than 20%, right? So that's non-qualified assets. If you're invested in non-qualified assets into mutual funds or exchange-traded funds, anything that generates long-term capital gains, short-term capital gains, or dividends, in that calendar year, you'll be responsible for the taxes that portfolio manager, he or she, resulted in by actively trading that portfolio. So when you're looking at different investment vehicles, you want to see how well they're tax managed. You want to find out what's the turnover and so forth. It's a lot of stuff that we look at. Like, we don't want to go into, if it's non-qualified, we don't really want to get into a very aggressive portfolio management team because it's just going to generate a ton of taxes. And I can tell you, since we just passed November, a lot of times people are like, oh, I got a little extra money. Let's go in and let's invest. It's like, oh, okay. They invest in November. What they do is they buy the dividend and capital gains of the portfolio for the entire year. So they sit there and they're like, all right, well, I got a 1099. What's going on here? It's like, well, you probably shouldn't have listened to that guy or gal. You probably should have just sat tight because all you're doing is buying a tax responsibility. Tax-free, everybody get that, right? Again, it's non-retirement stuff. Tax-free Roth IRA, cash value life insurance, and municipal bonds. The only one right now that we really should be looking at is the Roth IRA or cash value life insurance. Municipal bonds, because of the, I hate to use the term depression, but I think we all understand that if a bank down the street is lending to Joe and Jane Doe for a 30-year mortgage at 2.75%, then mortgages are pretty low, and bonds in general are very low. There's a risk reward that comes with that, right? So municipalities, when they issue bonds, they have to issue them to people who want to buy them. And you have to look at the credit worthiness, right? Credit rating, their claims paying ability, which simply means if we lend money, will you pay it back, right? Now, if you bought a bond from the city of Quincy, you'd get a higher rate than you get with the United States of America. Because the claims paying ability on the United States of America, which is kind of ironic, is with $30 trillion in debt, is better than the city of Quincy. We don't have the Federal Reserve just to crank out money at the Treasury, right? So municipal bonds right now, great vehicle, tax-free. However, the yields are so low, the value's not there so much. So what we look at is to gather the breadth of higher rated or lower rated junk, which is not a bad term when it comes to bonds. And we'd rather get, well, looking at your overall structure and your tax bracket, we'd rather get, if we could get the 7% high yield rate of return with equity exposure after tax, which would be an after-tax yield of, say, 4.5%, absolutely, 100%. We'll go for that more than municipals. Since we're in Quincy, and I love my hometown, Quincy's rating, I believe we're AA. That's pretty darn good, right? A lot of people talk about the parks that are being built, the infrastructure improvements, or the lack thereof, right? Different people or different departments getting raises, not getting raises, et cetera. All those different variables, they all boil down to one constant, and that is the claims paying ability of the city of Quincy, right? I've got to know our chief financial officer, Eric Mason. He's a brilliant brilliant guy. And I have a full faith and trust in his financial background as well as his expertise and the direction that the city of Quincy is going. See, when people talk, like, who lives in Quincy? Okay, so almost everybody, except the people from Minnesota. We all talk about, oh man, it's, the taxes are going up and so forth, ad valorem, the property taxes, et cetera. Yeah, they're going up, and I'm like you. I'm like, oh man, geez, can they go down? Right? Just go down. The reason, not to get into this too much, but the benefit of having the financial and fiscally prudent individuals at City Hall, granted we do see a lot of stuff going on, is to support the underlying debt obligations that the city of Quincy issues. And if we are issuing at a AA, that means it's a higher rated bond, and the issuance doesn't have to be at 5, 6%. It can be at 2, 3%. So we're saving a ton of money by doing that. Did anybody follow me? I shouldn't even get into that. But anyway, that's a call like, hey Jeff, tell me a little bit about that. And then again, don't tell me about that. I don't want to know anything about that. The one thing that we can walk away with the municipal bonds is the city of Quincy and the powers that be at City Hall are doing a pretty good job. No matter if you hit a pothole and so forth, the credit rating is really, really important. They're doing an amazing job in facilitating that. So tax-free, super important. Tax deferred. Who has a 401k or any of these? Right? Pretty much all of you. Why isn't your hand going up?
Because I'm just self, I have a traditional IRA.
Okay, good. All right, excellent. All right, so with these, if you sit down with a financial advisor and this is, her first question isn't, do you participate in your 401k? Get up and walk out, right? The reason is, this essentially is like free money, okay? Tax-deferred investment vehicles of the 401k, 403b, 457. Let's just go ahead and put this to bed. These numbers here, this is IRC, Internal Revenue Code. That's all it is. Just, that's what, oh, okay, page 55, all right, great. They're like page 401k. That's what it is. That's all it is. These investments provide the opportunity to either invest pre-tax, or if you have the benefit of having a Roth provision on that plan, post-tax, okay? So on a 401k, a 403b, a 457, they're all taxed at the same rate. The big difference between these, the 457 was created by politicians because that's what they do, and there is no 10% penalty should you leave that employer and take that money and spend it. Anybody else on a 401k or 403b, if you left your employer and took that money and said, I'm just going to spend it, you'd be taxed 10% penalty prior to 59.5, and then you'd be taxed as ordinary income. So I always tell clients before they start to dive in, if they lose their job and so forth, a lot of people are like, oh, well, I got $180,000 sitting in my 401k. I just lost my job. Oh, I can use that. Really? Okay. So let's dive into that real quick. If you have a 401k with $100,000 and you decide to use that prior to the date that you're supposed to use it, and that being retirement date, if you're under 59.5, you'll be taxed on the $100,000, you'll be taxed $10,000 right off the bat in a penalty. That's the penalty phase. And then, whatever your tax bracket is, your adjusted gross income for that matter, after all you're doing your taxes and so forth, if you're at that $100,000, you're going to be taxed at $100,000. They don't take the $10,000 penalty off the top, you're still taxed on that too. So, if you're at $100,000, say combined you're at $35,000 tax bracket, that means you're paying Uncle Sam of that $100,000, $45,000. So you're only going to net $55,000. We won't even get into the opportunity cost. The opportunity cost is something that people really talk about, but really briefly, when you take a loan from your 401k or your employer plan, it's like, oh yeah, no, HR will be like, oh no, you're good, take your loan. You pay your interest back, you pay yourself back. It's like, oh good. Yeah. And you're losing all the opportunity by missing out while that investment continues to go and grow, right? The S&P 500 was up 26%. If you took $100,000 out last year because you wanted to put an addition on your house, well, guess what? you just paid $126,000 for that addition. So that 1% return that you're paying interest on yourself didn't really quite work out. Obviously, it can go the other way. It can go down. But I always tell people, take it easy on the employee, your loans. It's nice if you get in trouble, if you have credit card debt, you're paying out 20%, 18%, et cetera, in credit card debt. There's nothing, the stock market can't guarantee you a rate of return. Take a loan, pay off the debt, and then pay yourself back through that, right? Because the one thing about credit card debt is the guarantee that you're paying debt. You're paying a massive expense. So with that said, if you're not participating in this, definitely contact the Human Resources Department and speak to them about doing that. Again, most employers, especially most private, this is a feature to go ahead and attract and retain qualified and good employees. So they usually put a 3% match on that. So how that works, if you're, say, let's again, you're making $100,000 and you decide, I'm going to go ahead and put $10,000 away. I'm going to put 10% away to my 401k. That goes in pre-tax on a 401k. So Uncle Sam looks at your W-2 and says, oh, you made $90,000. You didn't make $100. That money sits in that account. As long as it's in there, it's growing tax deferred in compounding the interest in all those taxes that you'd be paying in portfolio management and this. You retain all those, and those also grow. So instead of paying the tax man, you're retaining those assets, and those too are growing. So the 401k, 403b, 457, on one end is just an incredible opportunity that the government has given us. And on the other end, super PACs basically said, we can't afford pensions anymore, so give them that, right? Because nobody has pensions anymore outside of municipalities, townships, et cetera. We can get into that in a whole nother conversation. But yeah, it's like, really, thanks for this, but now I really don't have a pension, which would be nice because guaranteed income is really cool. We can get into that. There are other vehicles that you can get into that will provide that. So, asset accumulation, investment risk, it's inherent. In retirement, you have market risk, interest rate risk, health and longevity, safety, liquidity, short-term investments, long-term investments, growth-oriented. These facets here, right? Retirees face same risk as other investors. There's no discrimination within the stock market. It doesn't care who you are, how old you are. If you invest, you're going to have volatility. You need to carve out, again, compartmentalizing your budgets and your reasons. If you want to go on a trip like that, the cruise or whatever, vacation in a year, you don't buy a small cap emerging markets fund, right? You don't go ahead and load up. Amazon is great. It's at $3,600 a share. It's a blue chip. It's phenomenal. No, you don't do that. You look at a short-term investment for safety and liquidity. Might get a little aggressive, but you're not going, full bore into it. This type of positioning here is for retirees with 10 years plus. All right, if you have 10 years prior to retiring, you need to look at the overall path and say, can I afford that risk? Remember, if you lose 50%, how much do you have to make back to get back to even? 100, right? A lot of people don't know. They're like, I just lost 50%. You got to make 100% to get back there. Not many vehicles, especially after losing 50, will go ahead and recoup that. But anyway, any questions on that? It's fairly self-explanatory. I know I'm flying through it, but there are investments, they're inherent in everything that we do. It's all predicated on your time horizon. Risky, longer. Short-term, safety. Social Security, the biggest, this question comes up all the time. The number one answer to Social Security when people ask me about it, what is the question usually? When do I turn it on? Like, hey Jeff, come on, When did I turn it on? Like, you turn it on when you want the money. Just enjoy it. Turn it on when you want the money, right? The government plays games. Says, hey, wait a little longer. We'll give you a little extra, right? Okay, you go to 670. Oh, man, you're going to get 132% more. Just take the money. Because the thing is, it's kind of, it's not analogous to this, but it's like winning the lottery and saying, do I take the lump sum or do I take the annuity? No, you take the lump sum, right? You take the lump sum because you want to have control. Okay, and then wealth transfer. This is something that this is a 2-day conversation, right? But wealth transfer, there's 3 keys. Remember when we started this thing, right? It's like accumulation of wealth. It's like, okay, through savings, your checking and savings account, through investing, and then wealth transfer. We're in the process right now. We're right in the time where the greatest generational wealth transfer in our history, trillions of dollars, is moving through one generation to the next. It's fantastic. It's like, hey, thanks for dying. You gave me a ton of money. This is good, Oh my God, you had a life insurance? It was tax-free? Oh man, you did all right. Right, but that's the 3 keys are will. You need to have a will. Power of attorney, most of us have a will. Well, 40% of us. Power of attorney is always, but the healthcare proxy is super, super important as well. I don't care how old you are either. It's super important to sit down with a tax attorney and get that all in shape. You don't know, especially given the times that we're in with the COVID and all that stuff, you don't know when you may need the healthcare proxy, which is simply allowing somebody to make the decisions for you while you're incapacitated. It's pretty much it, right? So, wealth transfer, I always go back to this simply because of this. You can be the most savant investment advisor, portfolio manager. He or she can make you tons of money. It means nothing if you die and you don't have one of these, an estate plan, right? A will. And with that, I would say that the other number, everybody know the number 5 for the 5 years when it comes to estate planning? Get a 5-year look back. Right? That means the 5-year look back is Uncle Sam will come in if you need Medicaid and so forth, and you all of a sudden are now being put into an assisted living space. Uncle Sam will eradicate your estate. They will take everything, take all the money. And we've all been there, like with parents and grandparents and aunts and uncles and family. They will take everything. They will make sure that whatever penny you have left to pay that assisted living, it will come out of that estate and they will leave you nothing. Sitting down, spending that $1,600, $2,000 plus, contingent on the size of your estate, is the best money you're ever going to spend. However, here's the thing. You don't spend it. Your kids spend it. They pay for it because you'll be dead. All right? So, I mean, no, that's what we do with my mother. My mom was like, why am I paying, why am I paying this? You pay for it. I'm like, all right, I guess. It makes sense, right? But, yeah, it's important to have that. So, I can leave you with this, with the wealth transfer. So, I've been doing this now 28 years. I love what I do. I really do. I love it. And I enjoy my clients, even in the worst times, in the good times. It's great. But it boils down to February 8th, 1998. My grandfather, Charlie, lived on Freeman Street, Freeman, right off of Billings, across the street from Parker School. And he and my grandmother, Bernice, my grandfather had COPD. He was passing away, and it was his time. He was 82 years old, and back then, 24 years ago, 82, oof, man, he lived a good life, right? It's like, geez. By the way, on a side note, Betty White died at 99. People were like, she died too young. What a beautiful legacy. Like, that is just amazing. But on his deathbed, so we're all around him, and on his deathbed, my mother asked him, do you want some water? And he said, no, thank you. Such a beautiful man. And my mother said, Daddy, you okay? And he said, I'm okay. He said, just take care of Harry, right? And Harry's the pet name for my grandmother Bernice. And that time, like at that moment, I knew this is the career I wanted to do. This is what I love to do. My grandfather wasn't worried about what his portfolio was doing. He didn't care about what he worked at Polaroid forever, right? No longer. So he didn't care about that. All he wanted to do was make sure his wife of 62 years was taken care of. That's all he cared about. These different investment vehicles are available to you, right? From not only wealth transfer, but the accumulation of assets and so forth. We have a little time, we can talk about these different types of investment vehicles, but those are available to you, right? Talk to, go online, Google Fidelity, look at Putnam, Eaton Vance, the different mutual fund companies. Look at, there's variable annuities, fixed indexed annuities, equity indexed annuities. The annuities, they get such a bad rap. Anybody here have a variable annuity or an annuity in general? Okay, so an annuity is an insurance vehicle. And so it's basically like a mutual fund, but it has an insurance wrapper around it. It essentially says you can't lose money. So you put $100,000 into an annuity, you participate in the market, they being a sub-account, which is, any type of investment, American funds, Fidelity, Putnam, et cetera. If you lose money and you die, the beneficiary gets 100% of the money. It all goes back to them. So there's zero beta, as we refer to it. I use variable annuities and index annuities for a small, I carve out a certain percentage simply because there's no bond exposure. There's no bonds to buy. Bonds they're so depressed right now, it's impossible to go ahead and pick up anything more than, you go to a bank, I had $400,000. They're like, oh, we'll give you 1.25%. And you're like, whoa, really? That's pretty good, thanks. No, you deserve better. Thing with annuities is they get a bad rap because you have to pay for the insurance, and so the insurance cost. But when it comes down to it, you always look in life, I always use this adage that value is irrelevant in the face, price is irrelevant in the face of value. Will you care what you're paying if you're going to enjoy it and you're going to appreciate the value that you're getting? So if you're buying an annuity and it's cost you 3% in fees, insurance costs, portfolio management, and so forth, but you made 25%, your net is 22. Otherwise, you would have been sitting in the bond making 1.25. And you had the ability to go ahead and guaranteed income, guaranteed growth, et cetera, et cetera. But those are different things. I just wanted to touch on that. A lot of people talk about it. So with that said, I've got about 10 minutes left. I'm very impressed that I've been talking for 50 minutes. It's amazing. In the kits, you have this thing, this handout. It's defining what wealth means to you. And it just basically asks you, what does wealth represent to you as a person, telling stories about wealth. And it takes away the dollar amount and it puts into memory, creating memories. Really, we only have a certain amount of time to do this. Creating money creates memories. But it's something to go ahead and look at and write down things that you want to accomplish, right? And then on the back is your mission statement. I give these to all my clients. My clients are my friends now. And I give them to them and I ask them, call a family meeting, write down your values. What's important to you. Discuss your values, choose fewer than 10, construct your mission statement, et cetera, and then you live by it. And it's so simple to do because a lot of times, we're just floating out there. But if you write stuff and you hold yourself accountable, you'll begin to go ahead and accumulate wealth. Now, with that, I'm going to wrap, but I want to tell you real quick. I got into it the other day on Facebook, right? I put out something that going to 4 years at Boston College would cost you $384,000 without any financial aid, right? My niece and nephew were both at Colby College. I think it's, my brother's shelling out about $150,000 a year, right? But he's no longer a Quincy guy. He's up in Maine. And when I asked him, like, does it bother you, $150,000? He's like, No, I'm just very, I appreciate life. I appreciate being in a position to be able to afford it. I'm like, oh my God, who are you? I'm like, really? I don't care if I was a billionaire. I'm not showing $150,000 a year. Anyway, it's a great response, and I'm very proud of him. But, so I said, all right, let's talk about education, right? So take the $384,000. Instead of going to college, put that into, go to a trade school or whatever, somewhere you're going to be, it's not going to cost you anything, right? Put that into an investment vehicle that will provide some sort of tax deferral. You can buy an annuity with non-qualified assets. You retain all the asset, all the money that you'd be paying taxes. You allow that to compound. Take a guess on the average annual return of the S&P 500 of the life. Anybody know what that is on average over the last, say, 60 years? Around 11-12%, right? So at 11 and a half, I think I even put it at like 13 over the last 10, but over 11 and a half, anybody want to take a guess on compounded interest over 47, which would bring that 18-year-old, bring her out to 65? Anybody want to take a guess how much that would be worth?
Somewhere around 50 million.
$120 million, right? $120 million. That's what financial literacy is all about. We need to start educating our younger people to understand that, hey, listen, before you think that you need to go and, start dumping all this money into college education for something that you may not use, just because society tells you need to start to look at the fundamental principles of investing, right? Earnings matter. Invest your money. Start young. The younger is the biggest asset you have. And the last thing I'll leave you with, again, we talked about it already. You have 253 days of the year that you can participate in the market. Today's volatility, yesterday's volatility, last week's volatility means nothing. If it meant something, that means you are not well diversified or not allocated appropriately. And you need to reassess, sit down with someone, and address that. Clearly, take the risk off the table. All right, so we've got 7 minutes. What questions do we have? Yes?
What's your opinion of cryptocurrency?
Cryptocurrency. That's a great question. I'm down $84 in crypto. I'm not kidding. I took $250 and put it onto Dogecoin because Elon Musk told me that a dog with no value. It's something that I've exposed some clients to, mainly through ETFs, which an ETF is a mutual fund, but it trades like a stock. It's an exchange-traded fund. You can trade it during the day. If hell comes in a handbasket, I'm able to get out of the market for my clients before mutual funds have to reassess the portfolio, and it's a little tricky. But crypto, I don't know too much about it. I've studied enough to be dangerous. I've, again, carved out 1-2% for clients. I believe in it simply because the emerging markets industry is obviously, it's huge. It's a $1 trillion industry. The thing is, there's 3 constants that go with investing in emerging markets. It's the currency, the company, and the industry. You can have the best stock in the greatest industry, and if that country goes kaput, so does their currency. The cryptocurrency, Bitcoin, etc., Ethereum, they provide an even playing field where you can invest into emerging markets and not have to worry about what president, so-and-so is going to do to the, the rand or whatever, right? So I don't think it's going away. I don't think it acts as a currency, obviously. Currencies don't do what they do, the dollar. And then I'll end with that. I don't think the United States at $30 trillion in debt. By the way, we own 93% of that debt. So whenever anybody says, oh, China owns our debt, China owns 6% of our debt. And by the way, we're lending at basically zero. So they're building all our roads, we're lending money. It's like, yeah, well, we're not paying any interest on it. So we're just a safe haven because democracy is so important. It's a great commodity. But I don't think the Federal Reserve nor the Treasury is going to go ahead and allow crypto to overtake the dollar. The dollar is a soft currency. We went off that. The Bretton Woods Treaty well, forget it, I won't get into that. But we went off, we're a soft currency. Democracy is our currency. As long as we continue to maintain a capitalist society, this isn't politics or anything, as long as we get up every day, put our boots on and go to work, we are supporting the dollar. The dollar is the global currency. I don't see crypto ever competing with it, and if it does, I think that there's going to be some bad times for the crypto investor. Right. Any other questions? You're like, I'm a crypto. Yes, Minnesota.
What is currently recommended for retirees as opposed to money in fixed income and money held in the market?
Yeah, excellent question again. I would, fixed income, there's a need for it, right? However, I look at equity investing, I've been doing it, most of my clients are all in equity. For my retirees, we carve out about 24 months of income, right? So we have about 2 years of cash, short-term bonds, okay? U.S. Treasuries, et cetera. We put that in there. The majority is spread over a diversified portfolio that allows clients to participate in the equity markets, both international and domestic. Never in the history has a market not come back over a 24 to 36 month period. So we're able to go ahead and, dollar cost or systematically withdraw from the equity positions. Meanwhile, if we have another March 2020, we'll be able to go ahead and utilize that buffer with the cash that we have in place. So in order to maintain pace with the number one concern, which is outliving your assets. This is the number one concern facing every retiree today. It's not taxation, it's not market volatility, it's not control, it's outliving the assets. It's mandatory that you have equity exposure. And we talked a little bit about variable annuities and fixed index annuities. Those are other vehicles that provide you the peace of mind. We're always looking for Swan. That's all we want, Swan, right? Remember Quan? Was it Quan? Yeah, we just want Swan. We want to sleep well at night. That's all we want to do. And you can find those. They're available. But my big thing on that one is if you're going to talk to a financial advisor and all they're going to push on you is annuities, you probably want to walk out the door. Because it's like, why are you going there? Like, do you sell anything else? Talk to a financial advisor that's licensed, all to be at a CFP, a SEMA, Series 7, 63, 65, 66. The analogy I often use is if you talk to a financial advisor and all they can do is shop at Stop and Shop from aisle 1 to 3 and aisle 4 to, aisle 25 to 30, they're probably not a good fit. You want to talk to somebody that's going to be able to advise you through every aisle and be able to go ahead and select different investments from each aisle contingent on your risk tolerance and your time horizon. I know you have a question. Oh yeah, go ahead.
Can you go back to that slide with the 3 different, I forget what that heading was, asset accumulation? Yeah. So let's say I make $100,000 a year.
Yeah.
I want the one.
Oh.
But let's say I make $100,000 a year. How much, if we were thinking percentages?
Yeah.
I don't even know if the sentence makes sense, or my question makes sense, but how should I allocate that $100,000? Does that make sense?
Yeah, no, that's an excellent question. Let me see.
And then as a follow-on to that, I had a 401k, but my financial advisor suggested I roll it into a Roth.
Okay.
So now I have nothing in a 401k.
Okay.
I have no 401k. I just have a Roth.
Okay.
What is that?
Okay, so your Roth IRA, question is simple, she left her job, took her 401k, rolled it into a Roth IRA. How long ago did you do that?
A year and a half ago.
Okay, all right, so you've got to pay taxes on what you took out.
Yeah.
When you put it into the Roth. There's provisions that give you, you can ladder out and spread out the taxes, which is great. So now you're in a Roth IRA. You can put $6,000 a year away, right? Here's another thing, and I didn't touch on, and I'm glad you brought it up, so thank you. If you're in an employer that has sponsored a Roth provision in their 401k, 457, there is no income limitations on that, which means you can invest, if you're 50 or below or 49 or below, you can invest $20,500 into a Roth. Doesn't matter if you make $10 million into the Roth provision of your 457 or 401k, and $6,000 into your IRA for a total of $26,500. What does that mean? That means, unlike a traditional 401k where the money is going pre-tax, so instead of making 100, you put 10,000, now you only made 90. If you put 10,000 to a Roth, you still made 100. You don't get that immediate gratification of the tax benefit in the year it's put in. However, and this is why your advisor was smart to give you this, she directed you correctly because that money grows tax-free. If you're a pensioner and you have a pension and you have the ability to go into a Roth IRA, you go into a Roth provision. Simply because if you're a pensioner and you get, say your pension's $120,000 a year, and then you have a traditional 457, 401k, et cetera, you then have to attach that, so that's going to kick you up to a higher tax bracket. If you're in a Roth, guess what? You're right there. You do not pay additional taxes on that. So where your money is now, you're just in a Roth. It's a great vehicle. You can go wherever you want. You can trade it, do whatever you want. No, it's good. It was smart. It takes a little bite, because you got to pay the taxes. But over the long term, it's going to be, it's going to be phenomenal. That was a great move. What else? Yeah.
I think all high schools should have a course in personal finance that every kid has to take.
I think you're right.
Because they come out and they go to Dunkin' Donuts and then they have a $200 a month bill at Dunkin' Donuts and they think, well, everyone's doing that.
It's crazy. It's insane. I'll tell you.
Somebody's got to tell them before they go to college.
Oh, yeah.
Whatever they do.
Yeah. I agree completely.
Crap like that.
Yeah, I'll tell you, there's some city councilors that I've talked to that are talking about doing stuff like that.
High school kids, yeah.
Oh, yeah. Yeah. I'll tell you, my high school experience,
A college credit card.
yeah.
And the next
College
thing you
credit
know,
card,
they
what?
have $10,000 they've charged on it.
Well, those sneakers were worth it, I'm sure. I know we're running over, but in 12th grade, real quick, I go down to the woodworking shop at North Quincy High School, right? I walk in, I'm like, I'm gonna make some stuff this year. Like, stuff, crap, nothing. But Mr. Hogan, if you're watching, great stuff. I enjoyed 11th grade. But he's like, hey, Sullivan, what are you doing? I'm like, I'm ready to make a bookshelf. He's like, no, you're not. You're going up to Miss Tikanen's class because you are in typing. And I'm like, what? I'm not typing. My father called and put me in typing. I can type like the wind. I am an amazing typer, to the point where I miss those old keyboards that were like, but yeah, I was pretty good at it. So, but you're absolutely right. They should. I took, I think we're all in trigonometry, pre-calc. I've never used either of them. I'm like, huh? It's good to say, like, if you're doing a meeting at the local library and say, I took pre-calc.
You prep it hard a lot.
Yeah, exactly. When I was single, I was like, I took pre-calc. People are like, that's cool. Are you going to buy me the drink or go in debt? Anyway, any other questions? No? Well, listen, this is the first time I've done this. Again, thank you for the Thomas Crane. Last time Sullivan was here, it was my brother Jim. James Sullivan, if you haven't bought his book, Unsinkable, published through Simon & Schuster. Oh, yeah. Unsinkable, he did a Zoom meeting. It's about the USS Plunkett during the Battle of Anzio in World War II. My uncle John Gallagher, my grandfather Charlie on Freeman Street, his brother perished in the Battle of Anzio. He was the tail gunner, right? And we had 2 pictures of him, and that was it. And he was my grandfather's Irish twin. And my brother Jim started researching, and he found out more and more. And then he started Googling the USS Plunkett, and he found out there was reunions that they would have. So he was like, I need to learn more about this. There was thousands, tens of thousands of battles. Why is this not one talked about? So he started calling, and he got some people on the phone. And I'll give you a real quick story, and I know we're over, but he calls this guy Jim Feltz. And Jim Phelps answers the phone. He says, hello. He's 96 years old. He's like, you're going to have to speak up, Sonny. And my brother's like, of course, he's 96. He goes, I can hear fine. I'm at a home show. So, he's at a home show. This guy's there. My brother's like, he's 96. He's over in Ohio. And he's like looking at, to buy a backsplash, And he said, he goes, what are you calling? He goes, well, I'm a journalist, but I have a family thing, but this U.S. Plunkett. He goes, oh, I served on the Plunkett. And he said, oh, good. He goes, all right, well, call me tomorrow. And he said, listen, Mr. Phelps, before you leave, my uncle served on the ship. And he goes, a lot of men served on this ship. And he said, what was his name? He goes, his name was John Gallagher. And there was silence. And to the point where my brother was like, I think the call dropped. And he says, a voice came on the phone. It was kind of crackling. And he says, John Gallagher was a good friend. Just like, and that was it. That got my brother, who, by the way, he didn't decide, I'm going to start writing. He's a Mitchell Fellowship Award winner from the University of Iowa Writers Workshop Program. I mean, he wrote the National Geographic book on Vietnam. He's very talented in that space. But yeah, it came out last year. He just, I think, crossed over 30,000 books sold, which is, I guess, a big deal. My father's still with us. He's 82, and he'll call him and be like, I think he got a residual check. I'm like, that is none of your business. Are we still alive? Great, thanks, Ryan. Anyway, if there's no other questions, my business card's in there. If you have questions on anything we went over today, feel confident that I will answer the phone. I think my cell phone's even on there. I think the personal touch is kind of important. Next to your house, your retirement's usually your biggest investment. So I feel like we're family. Just call me if you have any questions. All right?
Thank you.
Thank you so much. Appreciate it. And thank you all at home for watching.